I found one of the most accurate financial prediction indicators ever. In fact, it's so accurate, it's been dubbed the single greatest predictor of future stock market returns. Now, in this video, I'm gonna explain what it looks at. I'm gonna explain how it works, what it's telling us now, and of course, most importantly, what we should be doing with our investments to take advantage of its future telling ability. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to take a look at the markets. I like to figure out what we can do to make money, invest our money, have overall success in life. If you like those topics, I'm sure you do, click on the like button right now. Click on the subscribe button so you're notified every time I put new videos out. Now today, we are talking about how do we predict the market? How do we know what's going on? And there's several ways that we can do that. Now, the stock market's 10-year return potential is better now than it was at the end of 2019 for reasons having nothing to do with the shape of the economic recovery or the speed at which the whole CV virus pandemic vaccine is being developed. All right. Now, that's surprising since most of the market's indexes have actually gone way up, right? They've gone way higher just this year, over 47% actually from the bottom. So how can I say the 10-year potential is better today than it was yesterday? Well, it's not that I have a crystal ball. I always say that if I did have a crystal ball, investing would be so much easier. But so far, in all my travels to all the most remote places all over the world, all my searching, I've never been able to find a crystal ball. So instead of having a crystal ball, what I do is I've always tried to use history. Now, if you watch my videos, you know I love to talk about history because there's so much we can learn from history if we only know where to look, if we only know, how to use it. Now, one thing that I've always used, looking back through history, is I use indicators. Okay, now an indicator, for example, would be like the yield curve inversion or the inverted yield curve. You've probably heard about that. It was making a lot of noise last year. And the inverted yield curve is basically it's a classic signal of a looming recession. Now the US curve has inverted before each recession in the past 50 years, and there's only been one false signal in 50 years, and the inverted yield curve fired last year. So what does that tell us? Well, here we are. We're going through a recession. But how did it know? How did it know a year ago that we were going to have this? Obviously, the pandemic, people say it's a black swan. How did it know? Well, for some reason it does. Now, no indicator is 100% accurate, all right? So what we do is we look at a bunch of different indicators, and we're trying to see a bunch of different indicators, and some are more relevant than others, and then we try to see the indicators that are saying the same thing. Like I said, some are more accurate, some may be more relevant, but this indicator, the one I'm talking about today, might be one of the very best indicators I've seen. It may be the most accurate indicator that we have. And I'm even going so far as to agree to call it the single greatest predictor of future stock market returns. Now, before I explain what it is, how it works, and of course, most importantly, what it tells us, I have to first tell you that I didn't create it, all right? I didn't name it. The honor belongs to actually an anonymous author of the Philosophical Economics blog, and he dubbed it, like I said, the single greatest predictor of future stock market returns. So how does this indicator work? And how can we use it? So if we take a look at it, it looks at the percentage of assets a household has in stocks. And then it looks at this percentage in relation to the percentage they hold in cash. So the percentage of stocks versus the percentage of cash. And it looks at that relationship. We call that relationship to cash, or how much that household holds in cash, we call that sideline cash. It's sideline cash because it's on the sideline, ready to be deployed at any given time. Now, the higher the cash levels that the household has, the more bullish it is. Now, you might have guessed it, household sideline cash is way up while the equity stock allocations have gone down. So we've seen cash go up and stocks have come down. And so what this tells us when we back test it, so we look at those indicators and we go back through time, we back test this indicator, it's proven that household stock allocation is actually one of the better predictors that we have. In fact, it's so much better that according to Ned Davis research, this indicator can explain 77% of the variation in the stock market's return in all 10-year periods since 1951. I mean, that's going back a ways. We've seen a lot of different markets, a lot of things have changed, but it's explained the variations, 77% of the variations in every market 10-year period since 1951. So I like to look at a lot of different indicators, but I'm not really aware of any others that actually do it this well. And at the end of last year, the household's equity allocation stood at 56.3%. All right, now as you can see from the chart that I have up on the screen, this was close to the peak set at the market tops in both 2000 and 2007. This is why at the beginning of this year, even before the CV pandemic was an issue, the stock market's 10-year outlook, it looked pretty bad. Now, how bad? Well, consider a simple economic model I constructed from a quarterly household stock allocation data since 1951, and the stock market's subsequent inflation-adjusted total return at each step along the way. Now, based on the year-end 2019 allocation level, the model projected a 10-year inflation-adjusted return of negative 1.3 annualized. All right, so that was based off of the end of last year, negative 1.3 annualized. Now, one thing to note is that this household equity allocation, it's not a short-term market timing tool. It's definitely not to be used to time the markets, especially not to be used in the short term. But that's just as well, because the data that we need to run this model, it's delayed anyway. All right, typically we get this data, it's backdated, it's updated quarterly at the Federal Reserve, and like I said, it comes with a pretty significant time lag. So like first quarter 2020 data has just been released. So it really kind of is like, that's why it works for 10 years. It doesn't work for the short term. But the data shows us that the allocation at the end of March stood at 49%. So that's a drop of 7.3 percentage points from just 3 months ago. Now, this is the biggest quarterly drop since the data began being collected all the way back in 1951. I'll repeat that. This is the biggest quarterly drop since we collected the data in 1951. So what does that mean? All right. Now, if we plug in the current data into this economic model based off the reduction in the stock allocation, it tells us we're looking at a projected real 10-year return of 2.3 annualized from the March 31st level. All right. Now, a lot's changed since March 31, right? We've talked about this. We had the big crash. We had a 47% return. The market's rallied back over 40% since then, which then actually reduces the 10-year return projection. But either way, the model's still projecting an inflation-adjusted total return for the S&P 500 of only 0.5% between now and the end of the first quarter of 2030. 10 years. Now, there's two things to keep in mind about this, all right? One, this is an inflation-adjusted return. So this also takes into consideration the coming inflation that we're going to suffer, right? We've had massive money printing, injecting trillions of dollars in the market, and so we're expecting to see lots of inflation. So this is an inflation-adjusted return, which means it's at least protecting your money from inflation plus giving you some return. The second thing to keep in mind is that while I've been doing many videos about the Fed pumping the market and returns being way more than 0.5%, and I believe they will be, at least in the short term. But remember, this indicator is no good for the short term, all right? This is only good for 10-year cycles. And a 10-year cycle will typically include booms and busts. So what I think is that, like I said, we've done several videos talking about these market cycles I'm expecting, and I think that we're going to see a big run in front of us, and then we're going to have a big crash. So this 10-year indicator covers multiple cycles. So it's going to cover that big run and the big crash, and it's where do we end up at the end of 10 years. All right, so like I said, it's long term. Now, the question you're probably asking is, how does this help me today? What the heck am I going to do with this information? What does it mean? What should I be doing about it? And of course, I always want to tell you what you should be doing. So the S&P 500 and the Dow Jones likely are going to be trading at more or less about the same levels in 2030 as they are right now. So what we want to do is we want to pay attention to the dividends, all right? Now, these are more important now than ever. And while those returns don't seem that exciting, right, they protect you from inflation. And that's the big thing. You still grow your money, and it's a heck of a lot better than buying U.S. Treasuries. Now, if you buy U.S. Treasuries, a 10-year Treasury right now is yielding about a minus 0.5, which means if you buy a Treasury and you hold it for 10 years, you're guaranteed to lose money, especially relative to inflation. So the best way to play this, all right, this is what we're going to do. The best way to play this is wait for a change, all right? There's a change coming. There's a dip coming. It's going to be one of the very best buying opportunities we have to buy the very best companies in the world. I call these the very best companies in the world. I call them world dominators. These are the most dominant companies in the world. They pay out dividends every single year. And if you can buy these at the right time and at the right price, they're going to way outperform the market over the next decade. Now, if you want to learn what these world dominator companies are, how to find them, especially how to find what I call the no risk entry price is, I just had a free training. I mentioned already, I did a free training last week where I taught the whole thing. And it wasn't just like some pitch fest. It was it was an hour of training that I just can't do on a YouTube video. And it was literally just me teaching you the strategy. And like I said, you can catch the replay at your own leisure. There's a link down below. You can watch the replay. But either way, my advice to you is ride the Fed put higher, okay? Ride it higher, but have a list of world dominator companies ready. So when the market dips back down, then you can buy these companies. So we'll ride them up, take our money out, and then we're gonna buy the dip on the world dominator companies at the right prices. And at that point, we're just gonna sit back, we're gonna watch our wealth grow, all right? It's gonna be easy if we get it right. Now, that's it. That's what I got for you today. Hopefully you like that. If you do, give me some thumbs up on this. If you don't, give me thumbs down, but let me know why. Leave me a comment down below. Are you gonna make a list? Are you gonna be ready to take advantage of the dip and buy the world dominator companies? Let me know in the comments down below. That's all I got for you today. To your success. I'm out.